Great. Okay, hi everyone, and welcome to our CBAM presentation. We've got Sam here to deliver his presentation on portfolio performance review and outlook for Q3 of 2025. We're looking at about a half an hour presentation today, and then we can obviously go on to our Q&A section at the end. So if you do have any questions for Sam or anything that you'd like him to clarify throughout the presentation, pop your questions over in the chat box on the right hand side of your screen, and we will dedicate some time towards the end to go over those. We will also then put a small survey up at the end of the presentation, so if you've got 5 minutes of time just to fill that out, that would be greatly appreciated. Otherwise, Sam, I will leave it with you.
Thank you very much, Jess. Good morning, everyone. Great to see so many people on the call today. As we go back over the last quarter and as we very much go into the finishing stretch of 2025. 2025 has been rather kind to us this year. Has kind of played out similar to playbook that we thought we would be having at the beginning of the year, as a generally positive year, but with a few bumps along the way. And the last quarter has been very much relatively bump-free. It's been all systems go, and been very much doing well in those conditions, which is always good. Mark, unfortunately, can't join me today, so you have myself, but just go through the usual T's and C's. This webinar is for information purposes. Anything I say in the forum isn't in itself investment advice or any other kind of advice. Cape Berkshire Asset Management, a little bit of a change from last webinar, is now a trading name of Ascot Wealth Management rather than a subsidiary. There's no change in how we manage anything, it's just a slight change there. Of course, Ascot Wealth Management is authorised and regulated by the FCA. These investments obviously aren't necessarily for everyone and are very much dependent on the investment advice that you may receive from your advisor, and that obviously tax changes as we go through time. Just as we take a look at what we're going to cover, so of course we'll go through our performance before looking at what trades we did on the quarter. Section 3 there, I forgot to change the contents before I distributed this. We will go through a review of just come off the back of conference season. So very much an update as to where an awful lot of institutional money is perceiving the world at the moment and how we're going to be positioned for that. And then a review of the beginning of year assumptions. I'm always quite surprised when I review them to see how much things do or have not changed since we made those in January, actually. Before finally looking at our positioning versus the industry benchmark, and then Q&A, as normal. First of all, good news is when we look at our Q3 performance, very, very strong. As you can see there, anything up to over 8% on the quarter performance. The lowest performing there, 2 2/3 performance there, but very, very positive quarter in general. And what's also very nice to see there as well is very healthy performance versus benchmark. So not only has the market been doing well, but we've been adding extra value in to our clients' portfolios, and that's what really, really matters for us. Both based on our internal benchmarks, so based on our internal processes, how we are performing those, but also when we can compare ourselves to our peers. You know, our industry peers within the discretionary fund management space, we see there on the quarter round about 1% outperformance on the quarter. So really, really happy with that. And that's even when in times in the quarter we've taken risk out of the portfolios, even when the market was still pushing on. So really, really happy with that. And then a continuation of this when we look at the year to date. We now see that performance for the year, we're now looking at over 10% on the 4 and 5 portfolios. P3 even is knocking on 10%. Even the lowest risk portfolios are having a really strong year this year, with another quarter to go. And then again, just showing the numbers of how we perform versus benchmark. And then since the P&R range, well, P kind of got relaunched, I suppose you could say, at the beginning of 2024, and I got launched at the beginning of 2024. We're talking less than 2 years, up to 30% return in that period, at least 12.5%, and versus our industry peers. Very happy to see, just selecting my little marker here, kind of over 10%, 8 to 9% there. Some very healthy numbers there, without performance compared to our industry benchmarks. We are definitely adding value into our clients' portfolios, and we're very proud of that over the last 18 months. It's been a very positive period indeed. Looking out across the quarter at the best and worst performing funds. So what's quite interesting is the worst performing funds in the quarter were the things that we hold as passives. Only one holding had a negative return in the year, and that was UK gilts. Seems to unfortunately be a bit of a common theme over the last 2, 3, even possibly 4 years now. See gilts there underperforming. We are at the moment concentrating more on the shorter term gilts. They are less sensitive to yield changes, to in essence what the interest rate that bonds pay out is. As interest rates can go up, anything that's already been issued, the value of those assets go down. So on the short end, they're less sensitive on that kind of change. And then, as you can see there, actually, the normal tracker was down 0.75%. However, the shorter duration was up around about a half, which is where we're starting to concentrate more on recently. Again, in terms of the actives performing well, we've got the Artemis SmartGuard Global Emerging Markets outperforming the passive equivalent there. And also in Japan, we got our active there in the number 4 place, whereas outperforming by about 1.5% the passive equivalent of it's held within the R portfolios. What I think has been really, really good is that the P portfolios have been performing so well this year, despite the fact that they haven't had a gold position. Which, considering the last 3 months of this quarter, 91 Global Golds has had a return of 52% in 1 quarter, which is quite remarkable indeed. And the reason why we haven't held a direct gold position within P is because it's been commentated on for some time that we are over and above a sustainable gold price, although the commentary always seems to be a little bit out of date, a little bit further down the road. However, what I've been finding quite interesting when looking at the last quarter's worth of gold miner earnings reports, and within them they put out their forward projections. The consensus kind of is within the gold miners a 12-month kind of budgeting window in gold of $2,600 per ounce to $2,800 per ounce. Bear in mind at the moment we're basically at $4,000 an ounce, so that's quite a pullback from there. However, one thing that we are very, very actively researching at the moment is perhaps looking at gold miners rather than the products and the people mining it. And the reason for that is that the difference between the contracted prices of gold as a product at the moment and the marginal cost for them to extract that gold is basically a record wide highs. And there's very much it appears that there's very much a catch up that needs to occur within the value of these companies. So that's an area that we are looking in. We're looking at the miners, not necessarily the product. So that's something to bear in mind there. Yeah, I think that covers that one. One slide that I forgot to change the quarter on. So looking at over the quarter, so when we at the end of July, we saw where the markets were in terms of valuation. We just started to take a bit of risk off, and the reason for that is that August, with everyone on their holidays, and this includes within markets as well. It tends to be quite a quiet month, but you do tend to end up with people starting to get ready for basically everyone comes off holiday end of August. Typically, you end up with a little bit of a September wobble if things are a bit expensive coming into that period. So we just took a little bit of risk there in preparation of that. However, we never got the wobble, and so we were quite quick there to start putting a degree of risk on about 2-3 weeks ago. So these trades have largely been reversed as we saw that market sentiment was going to continue for some time. However, in September, we did change an element in our emerging market fixed income space, emerging market bond space. Really interesting area at the moment. We did have half of our position there within within dollar-denominated emerging market debt. Research is really indicating that the local currency-denominated emerging market debt is probably going to be the outperforming area this year. So we took the opportunity to research the space again in our fund holdings in that space, especially considering the fund manager of the M&G Emerging Market Bonds Fund, not too long ago, literally a matter of months ago, retired. So an opportunity to review that space. I placed it with these two holdings here. And they're performing well so far, but admittedly it's only been a month. So proof being the pudding, but we have confidence there. And then finally, Webs down here, when we took some risk off the table, we put it all into just straight cash, just because of it would be very liquid for us to be able to buy things on the day if there was a pullback. Took the opportunity here to put that into money market, so it was only a better return. In the meantime, just as it became a bit more clear that we weren't going to be having the immediate pullback that looked like it was going to happen. Should have perhaps made these a little bit bigger. And then, yeah, as you can see, really active last week of the quarter. So what was going on here was that it was basically us leaning into equity markets a bit more, but in a responsible manner, looking at what's going on. So taking off things that were very more volatile in terms of how they act, such as UK inflation-linked gilts, and a bit more off of US government debt, and moving these a little bit more into perhaps better in the environment risk-reward kind of payoff elements. So looking a bit more on the American debt side, the short end of American federal debt, but it's the end that's far more exposed to interest rate changes down the short end, whereas avoiding what's going on for the long end, which is very much more dominated by the story about deficits, etc. We also took the opportunity to change our infrastructure holdings. So up till now, we have held a passive, in essence, a tracker fund in that space, just when we came back into it, as we saw the opportunity earlier in the year. However, this is a space where there's a lot of information dissymmetry. There's not so much widely publicly available data as there is in, let's say, US equities. And that means that there's more scope for an active manager to outperform here. So that's a slight typo. It's not the tracker. So we split our capital between the Aberdeen and Lazard funds there, and they have been definitely performing well. So we look forward to that continuing. And then one thing that is interesting here is moving to US smaller companies and Vietnam. Vietnam, as an investment trust, looked into there is a growing consensus that next year Vietnam will be upgraded by MSCI, who are a really important index firm, from being a frontier market, so kind of don't say irrelevant, but certainly not major at all, into an emerging market. And what that will mean is that the inclusion of that will mean that there will likely be an inflow of capital into Vietnamese equity, just due to the fact that it's included within, it's been moved up into an emerging market status. So we want to be ahead of that curve and hold the Vietnamese Enterprise Investment Trust. It's a good trust, concentrates very much on domestic demand. Vietnam is starting to accelerate back out of when it had a dip about a year or so ago, but also the story of Vietnam more generally I see has been quite similar to, say, China of not that far off of 20 years ago, in terms of that starting to liberate, open up, infrastructure spending occurring. All of these things should be very positive over the more longer term. So opening up that position there. Sorry, just excuse me, I just texted. Conference season review. It's been busy. And these are really, really good opportunities. And it's not so much the presentations directly that you hear, because they're quite similar to what we see on a weekly basis. What is far more interesting from these conferences is the things you hear ad-libbed and more informally. What I found very interesting is, I'm going to move on a couple of slides here because I've already gone early, is people started off independently across every day. They all said the B word. That B word is bubble. But it's important to put that into context, so don't get alarmed quite yet. So the whole AI story is still continuing to show very strong growth, and there is certainly productivity benefits that are happening within the services sectors. That is very clear indeed. There's incredible amounts of capital expenditure going on, both at the users of AI to be able to capture how to use it best and all that kind of element, but also within, in essence, kind of like the infrastructure build out of AI. So that'd be the companies that sell the chips and all of these elements that make it far more possible, well, certainly make it possible, but increase the capacity of it to do so. What we are starting to see at the moment is that the ability of these companies to finance the capital expenditure of AI out of just free cash flow, so that just being their surplus cash that's generated through the business, that time is starting to come to an end, and we are starting to see the beginnings of the more people raising bonds or doing a little bit more innovative financing situations, which we've seen in the last few weeks, to finance those build outs. That's typically something that you see at the start of a bubble phase, as I said, the start. What this is seen as at the moment is possibly very similar conditions to what I said in 1997. And I'll throw that into context. So you might hear people talk about the dot-com bubble that burst in 2001. And as I say, I'm saying about 1997 here. So we're some way off of that really bad point. What we saw in 1997 was a combination of a feel-good factor in the market, coupled with, as we're going into next year, a very loosening of financial conditions, which is helping to facilitate, increasing financing of these elements and go out that way. The things when this starts to become a bit more concerning is when these huge capital expenditures become very much debt financed, and we're nowhere near that yet. But this is what we need to keep an eye on before we get a little bit later into the story there. As I said, what we're seeing at the moment, we're seeing some situations where, for example, NVIDIA who are massive with selling the chipboards, that is propelling the AI boom. They are selling a huge number of chips to OpenAI, who you might have heard of. They're the company behind ChatGPT, in exchange for ChatGPT giving NVIDIA equity. So they're not paying cash for this. So it's just these other kind of deals that we're starting to see that aren't directly debt deals, but they're the start of things that are just shown as like, okay, we're out of the normal just cash phase, and we need to be aware of the risks that are going on. As I said, we're nowhere near in the proper worry phase of this yet, but it's something to be very aware of, and we very much keep our eye on it. Moving back to the US economy in general, because it's, at the moment it's really quite linked. The whole AI spend out is really a big part behind the performance in the US economy at the moment. What you see in the US economy at the moment is weakening jobs reports. That in itself isn't awfully surprising when you consider you had, obviously, if you remember, Elon Musk wielding a chainsaw at the beginning of the year. The whole Doge, or Department of Government Efficiency, cuts at the beginning of the year, and a few other elements going on now. Obviously, at the moment, we've got the US government shutdown. So you're ending up with a few weak job reports there. But as I said, corporate investment is really high at the moment. So it's very much show that companies are investing in their businesses, and that typically is a sign of a resilient economy there. Going into 2026, so the head of the Federal Reserve, his term comes to an end at the end of this year. To put it mildly, he and Trump do not get on. Therefore, he will not be going around for another term. You will end up with a board of the Federal Reserve next year that will be very, very much in favor of loose financial conditions. So what that means is that you're going to get the equivalent of the base rate will probably end up being cut quite somewhat next year. What will that do? Well, several things. One is it, as I said, loosens up financial conditions, so you end up with money flowing very well, and will be pushing up asset prices, which is why we tend to stay invested quite well at the moment. You'll probably also see, as a result of this, you will see a weakening in the dollar, partly due to worries about the independence of the central bank from politics, but also due to the fact that the real interest rate versus inflation will become a lot less, and therefore make other currencies more appealing. What we will also see as well is perhaps some of that risk seen from the whole lack of independence within the US Federal Reserve start to make the more 10-year and 30-year US government bonds, they become cheaper, pushes the yields up. So that's why I said we're concentrating more on the short end at the moment. Though it isn't it's not something people are talking about formally. I heard a few people at conferences saying that it might be possible that next year you see the US Federal Reserve try to keep a cap on those interest rates at the tail end, because it is the US midterm elections this time next year. And therefore, because, as I said about the independence of the Fed versus politics kind of thing, they're going to want a feel-good factor. All the things are lining up to try and get this feel-good factor going into the tail end of next year. Going with the tax cuts and spending changes that got signed off at the beginning of about 3-4 months ago, they're going to kick in January. So you're going to end up with all of these feel-good factors going on. They're going to push things up. But by the Fed trying to keep an eye on the tail end of these government debt yields, they're going to have to do that by buying them on the market. Basically, restarted quantitative easing, printing money. Again, that's going to put pressure onto the dollar. So it could be an interesting area to keep an eye on this year. Over next year, there's the belief that actually the US economy will pick up further into next year, which is why we're concentrating on those on the smaller companies. They're more sensitive to that kind of element, and also they're rather cheap versus the larger companies at the moment. And also they're very sensitive as to interest rate changes. So as interest rates are either kept a lid on or being kept down on short end, will help elevate the value in those smaller companies. So keeping them, that's the logic there indeed. Will be a positive area to keep an eye on over the next 6 to 9 months indeed. Going back over, made this 6 months ago now. Sorry, it's not that great on I should have split this up into 2 slides. But I tried to go over this, and obviously the slides will be able to be downloaded after the webinar. We'll go through this. So when you're looking at US inflation, it's actually moved into the more favorable part of what we saw playing out. Concerns over GDP haven't really materialized, but the reduced energy prices have come through. And the tariff wars have been resolved, but it's very clear that Trump's going to continue using tariffs as a bargaining chip for the next 3 years. When looking at US GDP, the base case exactly came in, slowing GDP into it says low 1% range, we're in the mid 1% range. Consumer squeeze, it's interesting in going again to what you hear ad hoc at conferences. Although the published CPI figures in the States are very much in, I think, circa 2.4% as I speak right now. When you hear from delegates from the States, they say it feels somewhat more than that at the moment. So the consumer is definitely feeling the squeeze going on. It's just not through to tariff wars. Construction is going very high at the moment in certain areas due to industrial build out. It's certainly happened, but it's more in AI. It's not necessarily due to tariff wars. Although there's the whole talk about, to settle these trade disputes, there's going to be like 400 billion that Japan's going to invest in America. It takes time for those kind of things to start moving. Very similar to when at the beginning of this year, we had that huge rally in Europe due to everyone thinking Europe's going to be throwing on the spending taps. It's great. People are getting, possibly especially US investors, it takes a long time for everything to go through bureaucracy and before you get spade in the ground. The money will start flowing very much in Europe with regards to spending on infrastructure, but we're probably still another 12 months out from that really starting to become apparent there. UK GDP base case came again, steady as she goes. Real earnings growth positive, real GDP growth around 1%, pretty much bang on. There was a point at the beginning of the year where there seemed to be an increased consumer confidence coming through, which would have been really good. So you could have seen that GDP move up closer. UK is possibly quite well orientated for its economy to benefit from productivity growth finally that comes around in AI due to us being a very services orientated industry in this country. Yeah, basically there. UK inflation wasn't far off. So the base case was for it to be in the low 3% range by end of the year. It's a little bit higher than that at the moment. It's 3.6. Tail end of this year, it's projected to be 3.3, which would be, I think, would be what was expected there. Energy is been moving in a bit more favourable conditions. OPEC, so that's the oil cartel in the Middle East, have said that they're going to pump even more. And it's keeping oil in the low 60s of a dollar per barrel area. This morning, it's not National Grid, but it's UK network operator something. It's got bought out not that long ago and placed within the government. Have said that this year we have the least likely of black stroke brownouts for electricity production, the lowest level of risk since 2019, the equivalent of 6 extra gas stations worth of capacity margin have opened up. That's a huge amount. So not so volatile in terms of energy markets for this winter. So that's good there. And there's still the elements of, we are seeing a degree of China trade diversion in cheaper goods coming into other economies, which might be a little bit better for the consumer. US Treasuries move from a 10-year to move to 5%. We practically, actually, I think it may have even happened around about 6 weeks ago. The results in largely a flat year for US Treasuries, but you keep them within most portfolios as a counterweight to if there's an economic risk, which in the US is a wise thing at the moment, because those job numbers they're quite volatile. The revisions have been quite large, so obviously bear in mind this is a country with 5 times the population of Britain, but you will end up with the preliminary print will say there'll be another 150,000 jobs created, and then the revision will come through, it's like, oh no, actually there was 60,000 less. So quite big swings there. So the market's quite sensitive on those at the moment, so you keep those in there as a counterweight to those kind of elements. One thing on this that I think was probably incorrect was our base case for gilts for the year. We were saying about how cheap they were versus Treasury. They've got on a nominal basis even cheaper. We're now looking at over 0.5% difference. So a 10-year gilt is yielding today 4.7%. A 10-year Treasury is now about 4.2. As I said, it did move up. It was higher than that a little while ago. I think we all read the news fairly regularly. We've got the UK budget coming up. We're ending up with a whole of our own making in terms of, let's not forget, we went into this government with them saying, oh, we've inherited a 50 billion black hole we didn't know about, to them now making an even bigger black hole. It looks very much like we're heading for an extra taxation situation. It's been quite clear that they tried to put the cart in front of the horse by putting the spending parts through in the last budget without doing the cuts on reforms. So obviously we had the talk about changes in disability benefit reforms. Earlier this year that failed to get through. I think there was a pension credit reform, etc., that failed to get through. There's the lack of political will within the Labour Party to get through the spending reforms through that would allow the other elements of spending to occur without tax rises. So expect there'll be one of those situations where they won't change the headline rates on like income tax, national insurance, and VAT, but they'll change what's included in it, or they'll change the definition of things. It'll be one of those kind of things. They'll raise tax by stealth. unfortunately. US equity, tax cuts and deregulation narratives kick in. Yeah, narratives kicked in. We're going to that. Actually, we've gone into favourable territory, full recovery to pre-April valuation multiples. That's exactly where we are. Indeed, we're certainly in a favourable camp on US equity. And then looking into infrastructure, excuse me. I think actually, fortunately, we moved into it after this event, but I think the unfavourable situation occurred with the below expected inflation outlook in the States, as we're expecting, those tariffs to knock on, and the higher US Treasury yields that certainly occurred. So we moved in after that point because we're kind of now locked in with the higher yields with the below expected inflation outlook means that the difference, so the real yield, so that's the yield you get after inflation, is now very appealing in that space. So that's why we're holding that. Again, I do apologize. There's only so much I can get onto one slide. Not masses different here. Just as I said, the things that are flashing big red, quite often you'll find they're in other areas. By definition, the only one that is definitely an underweight is North American fixed corporate interest. Just it's very, very expensive, and the terms that a lot of that bond that is written on in the United States isn't such good quality as it is in other parts of the world, such as in Europe or, strangely, emerging markets. That never used to be the case. So we definitely have a preference for those areas there than we do in the US. We do actually hold UK corporate fixed interest. It's just in different forms. So it'd be sterling issued notes within Europe quite typically. So that tends to go over into the global category there. But otherwise, we're trying to stay quite close on sectoral benchmark, just because we don't add too much active risk into the portfolios, and we're letting our holdings instead, our active performing managers, to go and deliver that for us. And as we see from at the beginning, it's a policy that's working very well for us, and we want to keep that going. But yeah, I'm a little bit over. I'm at 25 to 11. Sorry, 25 to 12. So Q's and A's.
Thanks, Sam. We don't have any questions at the moment, other than just a small point out of the Q2 rather than Q3 on one of the slides. But I'll just leave it for a couple of minutes just in case anyone else got any last minute questions to pop through. We will obviously pop through an email with the slides and the recording to everyone who has signed up for the webinar within the next 24 hours. So feel free to watch it back, and if you do have any questions off the back of that, I'm sure you can reach out to Sam and he'd be happy to go over anything that needs clarifying. And obviously that is the case with all of our webinars. If you sign up to them and you can't attend later on down the line, you do receive the slides. But we do have one question that has just come in, Sam, on Gary, and it says, any feel as to what to expect in the upcoming budget?
On specifics, no. What's been floated out there at the moment has very much been as I just mentioned, tax rises by stealth. So we have seen. So obviously there are certain services, certain products which are excluded from VAT, or they are zero rated, and they might be moved into 20% category. It's estimated that what I read, that bringing another £6 billion for the Exchequer, or to read it another way, we'd be paying another £6 billion. So it's things like that. I'm seeing very much definitions of things change. There was originally an intention for tax allowances to start growing again from 2028 onwards. That's probably gone now. That's probably going to be a 2030 thing at the earliest. Again, increasing taxes by stealth, which I think would be then no change in the income tax allowance since around about 2020 would be a hugely long time of that being no increase in that there. So that will certainly hurt. It's all these kind of areas that I've been finding. One thing that we're hearing, but it's only been in the more tabloidy press at the moment, hearing about changes maybe to tax-free cash from pensions, possibly. But I'm only hearing that in the tabloids, not seeing anything like that within the more financial press. And unfortunately, that's more the advisory side of the business rather than the investment side.
Okay, thanks, Sam. We haven't had any more questions come through, so I am going to pop the survey up for anyone that has got a little bit of time just to fill that out. Otherwise, we will see you at the next quarter review.
Thank you, everyone. Have a good day.